Hey everybody, thank you so much for joining us. And we're going to take a look at where the yield is coming from. It's been a hot topic here the last couple of months. I'm joined today by Lex, Josh Donner, Winston Zhang, and Cooper Emmons. Did I get that all right? Yeah. All right. Well, I'm going to first let our panelists here introduce themselves and talk a little bit about the projects that they're representing.
Great, thank you. I'm Alex O'Donnell, so I'm CEO of Umami Labs. We work with Umami DAO, which is an Arbitrum-based DeFi project. We've focused for several months now on what we've referred to as real yield products. So that sort of the philosophy behind everything that we've built on Arbitrum is this idea of tapping into sustainable protocol revenues, having completely non-dilutive emissions of our own token, and trying just to offer risk hedged exposure to on-chain revenue streams. So that's a brief summary of Umami.
My name is Josh. My background is I was one of the first 30 or so wallets to buy a CryptoPunk, so I kind of have this OG punk background. I work with Mycelium, and Mycelium in 2019 were the first price oracles on Chainlink. We're also amongst the first or second in grossing of price oracles on in that ecosystem. We support half of all their data feeds and are about 6% of their nodes. And with those data feeds, we decided to do TracerDAO, which is a derivative primitive on Arbitrum, and we partner with Umami on a number of products that uses our composable derivatives within their vaults.
Hey guys, my name is Winston, and I'm one of the co-founders of Cega. That's spelled Cega. We're building the first exotic options protocol in DeFi. So as a user, you come to our web app, connect your wallet, deposit stablecoin into our vaults, and those vaults trade different exotic options trading strategies that generate yield.
Hi guys, I'm Cooper Emmons. I work on strategy and business at Ratio Finance. We're a quantitative risk assessment protocol, and our first product is a collateralized deposition. So we take in yield-bearing forms of stable collateral and allow users to mint USDR, the first dynamically risk-adjusted stablecoin, against their positions. Super excited to have a great conversation today, and want to give a huge shout out to Bill and the whole DeFiCon team for having us.
Absolutely. Yeah. Thank you guys so much. Okay, so we all want to earn yield and make money in crypto, but it turns out you can also get wrecked like in a blink of an eye. So what are kind of some of the strategies that you guys use to hedge exposure to yields, and like how do you approach risk management in general?
I can start that off. So maybe I think to really frame this properly, if we're talking about yield strategies, we should talk about the underlying source of yield first. Sure. Umami, and other people use this term as well, so I don't want to, be possessive of it in any way. But Umami, our team coined this term "real yield," #real yield, which you might be seeing on Twitter if you're kind of plugged into crypto Twitter. Our community mod, Mr. Grumpy Pants, is his Discord handle, coined that a couple months ago.
It.
And yes, Josh retweeted it. So I guess the thing that I want to highlight is that, if you want any kind of sustainable yield strategy, you need something other than token emissions, incentive emissions as the basis of that strategy. So before you even start thinking about kind of risk hedging or sort of specific yield strategies, the question needs to be, is there some sort of value additive on-chain product that's capturing, that's generating value and then capturing that in the form of usually fees, right? And any number of things, whether it's exotic options or risk assessment, can be a value add that does that. But once you have that meaningful on-chain revenue stream, then you can start talking about what kind of strategy do we want? Are we targeting a specific delta? What kind of hedging do we use, et cetera? And in Umami's case, we work with Mycelium, TracerDAO, for our hedging strategy, and we work with another really excellent project on Arbitrum called GMX as our primary yield source. We provide liquidity to their exchange, and we collect protocol revenue from them denominated in ETH in exchange for that. So that's a very high-level view of our strategy, and I'd love to hear other people's.
Yeah, I'll kind of build off that. So our part at Tracer in the Umami Vault is the 15% that is allocated to hedging the exposure of what is in GLP. So when you deposit, if anyone's familiar, has anyone used GMX here? I love it. GMX is a great protocol, by the way. So within the GLP, there's exposure to ETH, Bitcoin, and a number of other assets. And with the vault that Umami's developed, they then hedge out that exposure on Tracer. And what we kind of innovated there was having these derivatives that can live on chain, sit inside a smart contract, and you can just mint them permissionlessly. And you don't need all the rebalancing and advanced infrastructure that FTX would have with their leverage tokens. You can actually just do it at the smart contract level. And so that's kind of how you have the great yield and APR from GMX's GLP, and then just mint out the hedges on Tracer. So that's kind of how our two products work together. And I think on Arbitrum, it was really cool to see a three-way kind of collaboration between Arbitrum projects, and we really leaned into that from the community standpoint to get people excited that, wow, there's 3 projects native to Arbitrum working together.
That's awesome. I mean, it's funny. Like we have 2 Arbitrum projects here and then 2 Solana projects here. So bring a bit of like different.
We love each other.
Exactly. Yeah. So for Cega vaults, the yield is actually pretty straightforward. Options instruments have value because if you want to hold that option to do something in the future, you need to pay money to have that option. So with exotic options products, users who deposit money into our vaults are effectively selling options, and the counterparties who are buying those options pay for those options and pay that money in the form of yield to the users. So this is about as real as the yield gets. There's no inflationary tokens, there's no emissions or shitcoins. It's just the options premium from the price that's calculated for these exotic options. And in particular, what makes the exotic options more exciting and beneficial for users than trading vanilla option strategies is that you get 2 to 3 times higher yield than trading a vanilla option strategy, but you also get some downside protection, which is really important because there's actually a lot of risks associated with obviously trading options of any form, but particularly with just trading vanilla options. And so for our users, we're offering this superior yield opportunity along with a safer investment product in the form of downside protection.
Yeah, no, I mean everybody's done a great job of kind of summing it up, but I think it all comes down to really, these are cash flows that we're talking about, and we're talking about, what are the value adds here? What value adds bring in and accrue what value, and then where is that value then driven to? What we're doing at Ratio Finance is we've come out with the first ever ratio risk rating system, similar to a Moody's or a Fitch style rating system. And kind of the proof of concept is on our collateralized debt position, where you can go on and you can deploy yield-bearing LP, such as a USDC, USDT, which would score a AA or an A or a AAA. Whereas if you had a much less liquid stablecoin also paired with a USDC, it would rate much lower, maybe around a B or a C range, right? So, to get back to kind of the question, like kind of one of the main purposes of what we are building is to allow users to understand, where is the risk coming from? You so often see this, 22% APY on stables, right? But if you jump into it, you find out that 21.9% is coming from emissions and just, a bribe effectively. And the other 0.1 is the actual sustainable fees coming from the, 1 BIP that they're taking on the swap. So, super interesting. I think that, creating products that, transparently lay out to users where the yield is coming from is kind of maybe the first step in something that we're seeing and understanding now. And I think that the new focus is now protocols that are truly focusing on not just building something cool, but building something that really accrues value.
Yeah, go ahead, Josh.
Can I build on that real quick? One thing I love about what Umami's done specifically is they've created a programmatic strategy for people to access these types of opportunities. And, typically, unless you're a highly sophisticated, day trader or understanding risk management, these things are out of reach for average people. And so I really love the idea of vaults and vaults that especially encompass multiple components or different protocols in one product to give people kind of those strategies, but in a programmatic way. And so, I appreciate what you guys are doing around risk, ratings. I think is really great.
Yeah, thank you for sharing that, Josh. And I'll build on that a little bit. Yeah, I think that there's sort of two questions here, and one is there something that qualifies as real yield or sustainable protocol revenue, right? That can be the basis of some kind of yield strategy. But then the subsequent question that Josh just touched on is is that strategy accessible and not just for sort of novice retail investors? It goes deeper than that. I think a more relevant point is it the case that this strategy is so hairy, if you will, that it's not going to attract TVL at scale, whether from retail or institutions, right? And if that's the case, then you could have an incredibly value additive product, but it's not going to see its day in the sun, if you will, because you're going to have trouble scaling TVL. And for those of you who are operators or users on DeFi, in the DeFi space, that the issue of insufficient liquidity is pretty much the biggest bottleneck, even for otherwise excellent products. Some entire chains are effectively constrained by that. So I think that one of the key things at least that we're thinking about in Umami, as Josh alluded to, is how do you take a value additive product, for example, providing liquidity to an exchange, in order to receive a cut of exchange fees denominated in ETH or USDC. How do you take something like that, knowing that there's a variety of, sometimes quite exotic risks associated with it, and package it into, ideally a, permissionless, trustless DeFi smart contract that, for the user abstracts that complexity away and lets them get, fairly risk hedged, either delta neutral or otherwise sort of predictable delta yield, right? And so for us, what we've identified is that institutional capital, they of course like stables, and they also like Bitcoin and ETH as core crypto assets. Anything else is a little bit exotic for them. So if you can engineer strategies that offer double-digit APR based in sustainable yield from protocol revenue on USDC, BTC, and ETH, you have something very, very compelling. So, I think on a high level here, the challenge is, first of all, find the underlying value additive, source of revenue, and then two, structure strategies around it that, allow a really broad user base to have, exposure to it and help facilitate mass adoption, which is, of course, the goal.
Yeah, and just to jump in there, another thing that I think is worth noting here is coming from traditional finance perspective, you see higher APR, higher APY, you think higher risk. And that's just the way it works in a mature market. When you have these two different baskets of both sustainable yield as well as, I love the term, sustainable yield as well as emissions on the other side of things, it's very hard to differentiate. Like we take a look at positions at Ratio, which are spitting out 2% APR, but are incredibly risky. But then you can find a position that has a 22% APY and it's incredibly safe, right? And that isn't, obviously we'll see things mature and things will change, but that is, something that we're trying to illustrate to users, because a lot of the time it's not transparent and you need to be able to dig all the way through to find out kind of where the yield is coming from and why it's there.
Yeah, I'd love to hear more about how you guys are educating. So it's obviously very difficult to market a yield when you have the historical DeFi projects, right, that are offering hundreds and hundreds percent APY. I remember when the Rook, the protocol that I worked for, when we were first launching our coordinator, we were told that if we didn't have over 20% APY, it wasn't even going to be interesting. But it's that same real yield that is coming from your protocol, and it's just really not possible at that point. So what are some of the steps, what have you found is effective? And I love the term real yield. I've seen real yield summer so much on Twitter. We've been sharing it internally a ton. Big fan of it, love the term. But what are some of the ways that you're educating users just so they're not looking at a 17% yield that's relatively safe, safe all things considered, but compared to like a 65%, a farm or anything like that.
Yeah, I'll share some thoughts, and I can't wait to hear other people's as well. So, look, in our case, there's a few points that I'll make. First of all, even if you're looking at kind of what you might call sort of a degen retail user base, at least at Umami, we've been very grateful for the recent market drawdown. It's had some really salutary effects for us because with ETH down, it brought down most of these Ponzu projects with it, and I do feel, I'll say particularly after sort of Ohm fork season, if you guys remember that, 1.5 million % APY, right? Like, people know better at this point. I think that if you advertise something that sounds ridiculous, people now understand that it is ridiculous. So that's been great. But that being said, I still think that the entire narrative within DeFi is still too insular, too focused. This sort of self-referential, analysis based on what other people on crypto Twitter sort of might think about a particular project, right? And the truth is, as soon as you get outside of that bubble of DeFi users, you realize most people, they have they've been used to 0.5% APR as a high yield savings account, right? In TradFi. So for us, we feel that we need to punch past that core mostly retail crypto user base into institutional capital. And for them, they are going to see 12% APR relative to whatever the relevant comps are in TradFi. And that's highly compelling. And then it's really just a matter of demonstrating for them. The question is, well, how is that safe? Because that sounds high, right? And so that's a different educational challenge. But if you are, in fact, basing it on real protocol revenue, that's a pretty easy narrative.
And just to jump quickly, I find talking to the traditional finance people and a lot that are making the jump into the space, like they just are like they don't understand. They're like, how is this possible? Why is number so big? So I completely agree there. It's there's a huge educational piece.
Yeah, I was gonna say it's interesting because retail has been so burned by these crazy APY schemes of the past that I think they now approach those big sticker APYs with a bit of just like skepticism. And I think what's interesting for us at Cega is that we have vaults, like our most conservative vaults is a 11% APY Ethereum Bitcoin exotic options trade. On the upper end of the spectrum, you actually can find a 79% APY vault that trades Ethereum Bitcoin and Solana. We also have like a degen vault for fun that has 5 million in TVL, and that yields 100+% APY. And so what's interesting is, when we have these sort of APYs on our web app, we have to think about how consumers view those numbers, because I think in the olden days they would have rushed to deposit into the vaults, but now there's a lot more questions. And so I think the best way of addressing that is to just meet those concerns up front. On our web app, in the vault details page, we list the risks. We make sure that the consumers understand how the yield is coming from, also what it means for them to generate this yield. And so for consumers who invest in our vaults, they're collecting the APY from the options premium, but that's if in the next 30 days, the prices of the underlying assets don't fall by 50% or more. If there's a 50% decrease in the value of the underlying assets, then the users risk some of their initial investments. And so I think as long as you're communicating the risks associated with the returns so that users can pick the products that meet their risk reward profiles, it's actually fine to have these high sticker APYs.
Yeah. What is real yield? Real yield is revenue. And in any sort of business in the non-crypto world, if you don't have a business model, you go out of business. And one thing we've seen with what GMX has been able to prove and show is that you can basically build a really great exchange business in DeFi and have it be sustainable and have it perform really well. And I think the entire space is now looking, as liquidity is dried up, they're looking around the ecosystem. They're saying, what's actually generating value? What actually has a business model? And so even in our own exploration of where we're going, we look to kind of those models and say, wow, it's proven, it's here. The data shows that it exists, that there's a community around it. So I think what you'll see in the next 6 months of DeFi is they'll be looking at business models in other lines in crypto, whether it be in exchanges, lending, et cetera, and say, how do we recreate these on Arbitrum or Solana, et cetera, and have it be sustainable and attract that kind of what we call real yield, which is essentially just protocol revenue. It's a real business model. So I think we get caught in the minutia of APRs, but what we're talking about is actually just delivering value and having a business model.
Yeah, absolutely. And there's so few of those protocols right now that I feel like it is tough because it can just get lumped in with everything else, where it's just basically a way to distribute a token or something like that. So obviously, the centralized lending has been I guess, in the news lately. With May, June, we had a number of centralized lenders blow up, and those were almost considered the safer options for a lot of people. What are some of the advantages here, or what are the differences between the DeFi yields or these centralized yields? What are the advantages here of yields on DeFi rather than, say, a Celsius?
Before I hand this over to you guys, I actually have a personal story here. So I am from Toronto, and we had an exchange called Quadriga CX in Canada that exploded about 3 years ago. Took away $250 million of Canadian wealth, which that was like at $100 Ethereum. Kind of sucked, not gonna lie. But in that expiration, I kind of look at what's happening with Celsius and Voyager, which is also listed on the Canadian Stock Exchange, by the way. Some of these, these protocols were publicly listed there. And I think for us, like, I always got frustrated that in 2015, when Gerald Cotton, who was the founder of Quadriga CX, was building his business and it was getting traction, he didn't have any sort of, adult in the room per se that was, sitting down saying, here's KPMG, they're your auditing firm, and here's kind of our regulatory expectations, and here's your Canadian banking partner. And as TD Bank started shutting accounts down, it forced Quadriga to use third-party lenders and third-party payment processors that really added a lot of systemic risks to the Canadian crypto economy, let's say. And so, that's kind of a personal story that blew up, and I think now the regulators are getting involved, which is great. I'm pro-regulation in where it makes sense, but yeah. So.
Well, I just want to tell. I mean, do you remember back in 2017, 2018, the proof of reserves?
Proof of reserves, yes.
Proof of reserves days when everybody would just
take
their money off of centralized exchanges and just say, like, can we still operate?
And if you watch Crypto King on Netflix, that Telegram group, I was in it, and Sifu, I still go back and forth with them on Twitter once in a while, so, yeah.
Yeah, I mean, I guess one thought that I'll share on this is that it's worth asking, so if Celsius and Voyager were considered sort of the safer options, right? Certainly, by sort of institutional capital or, just people who are less crypto savvy, why is that? Given that, there actually were in fact these very high risks associated with centralization and, the fact that they had custody of the assets. And, I think that what we're starting to see, but are going to see more of, is that, people are recognizing that what made those products attractive was that, they, for one, they gestured towards regulatory compliance. They usually, did operate within, whatever the compliance framework was of the jurisdictions they were in. They, could speak the language of TradFi, more effectively, and, they packaged their marketing and product offerings accordingly. And that produced, I think, a comfort level for a lot of the, the depositors and users that, frankly, in that case was misguided, right? And with that full understanding to be, non-custodial, and the security them is that I think what we recently do job for the D space to kind of leverage what's happened to sort of highlight, look, this is this is what we've been talking about this entire time in terms of trustless smart contracts on chain. But to do that really involves repositioning a lot of what our projects and our products so that they are regulatory compliant, or at least we do the absolute best that we can to create regulatory compliant structures in the jurisdictions we're in. That we focus on kind of blue chip best practices. We should have white papers. We should have back testing. Every product should be audited, and we should have marketing that really appeals to and connects with a broader audience outside of like I said earlier, crypto Twitter. And I think that as that pivot starts to happen within the DeFi space, the narrative of trustless, permissionless, non-custodial smart contracts as the safer alternative to a CeFi entity will start to resonate with funds because it's simply true. But there just needs to be a little bit more thoughtful positioning, I think, by the space to really take advantage of that.
Yeah, I think one of the other concepts too that emerged from the CeFi incidents that we saw in the last few months was the idea of transparency, and I think that also dovetails easily into this concept of yield transparency as well. And to your point, Josh, about trust, I think trust often comes hand in hand with transparency as well, right? USDC has a reputation for being one of the most trustworthy stablecoins, even though they're centralized, because they've been among the most transparent with the underlying asset, what the makeup is of that portfolio. And so I think one of the biggest advantages of DeFi, and I think why there's so much excitement for builders of DeFi, is that I think there's a natural higher level of transparency and expectation of transparency for any DeFi protocol. There's more open sourcing, security auditors have to review the code. And so as a user of a DeFi protocol, I think, why would users prefer DeFi versus CeFi? I think the transparency of DeFi, or the more transparency that you find with DeFi, means that there's less unknowns for users. And I think that should lead to more trust.
Really quickly, when your protocol launched a month ago, how did you guys position that to your community to hit on all those things?
So we did a lot of user research with our community before we launched. We wanted to understand what types of products resonated with their needs. We wanted to understand. We actually did copy testing too. And so basically, things that we heard from our community, we actually heard that because of the bear market, users were more risk averse. And so our initial launch plan was to have all products have a 50% price protection floor for the exotic options trade. And in 99.9% of cases, these underlying assets don't fall by 50% or more in a 30-day period. But the feedback we got from users was that they actually wanted even more protection. So then we launched a 90% price protected floor, which means that if you're trading this option strategy, you would need Ethereum to fall to $180 or less for you to lose money. And so talking to users and hearing what they wanted led to changes in our products, our marketing. Users asked us a lot about, are you doing security audits? When can we see the security audit report? So we actually did two. We did one security consultation while we were developing the code base, and then we actually did an audit once we did the code freeze. And so I think that level of community engagement and community transparency was pretty important to us, and I think went directly into our mainnet launch.
Yeah, and additionally, I just think I think to build on everything that's been said, the level of scrutiny per se is just so much higher within the DeFi world rather than the CeFi world. And to add on to that, something that I think really hasn't been brought up is that in the latest blow up here, we've seen the Celsius Voyager situations. You didn't see any of that happen with the Aves or the makers of the world, right? Those guys just kind of all pushed on as expected, and it's because they run such transparent, in DeFi everything has to be so transparent because everything's on chain, et cetera, and the open source code bases, as you just mentioned. So I think back to the original question is that, in times like this, there's no black box in most cases. Everyone is kind of really sure what will happen when something occurs. And in the cases of Celsius and Voyager, clearly that wasn't the case.
Really, really quick on that blow up. We knew the liquidation price of, well, potentially Michael Saylor. We knew the liquidation price of, some of these centralized lending platforms that had outstanding loans, 3AC, on Aave. We knew the liquidation price. And I think that's a powerful thing to have in the market, because it allows market participants to come in and set a floor. And to a certain extent, we could look at the SBF moves as kind of putting in a floor. I know Binance may or may not have said that they were also going to put in a floor. But these are kind of like the Warren Buffett moments of our bear market. But I think it's really cool to see that transparency versus the margin calls over Telegram just don't work.
It's a great point, and I know that, I've been in crypto since 2017, and it's always been, for the first three years, it was all centralized stuff, and you just never knew what was going on. So like, hopefully we get there with just everything is just absolutely transparent, and like, and building projects like with the community here. Like I can't even imagine how much of a benefit that was when you're like tailoring products to people in your community that are like users, right? Like that. You don't really get that anywhere else. So I would like to, ask, so say I'm new to DeFi, right? I'm looking for a way to earn, right? I want to put my money to work. Where do I start? Like, how do I go about researching this stuff? How do I go about finding a yield? It's just a dark forest out there, right? And with all these different opportunities. So I just would like to know a little bit about like how you guys research new projects and find these yields and assess these yields for their sustainability.
Yeah, well, to start, you can go to ratio.finance. No, I'm kidding. So effectively, that's a great question. I think, how do you find that, what we're trying to achieve at Ratio is this risk rating system on existing stable yield-bearing collateral, right? And what makes these things risky, what doesn't. We have an incredible risk team, but things such as the LP, for example, the LP, you effectively, if you think of it as two companies, company A is taking on credit risk exposure to company B, because if one fails, then the pool, there could be dilution and you could lose liquidity and et cetera, et cetera. So, if you're a beginner to DeFi, I think that the answer is going somewhere where you can transparently see where the yield is coming from. Is it coming from emissions? Okay, effectively emissions are just a bribe from the protocol. Is it coming from fees? Are they taking 1 BIP on a stable swap and paying that out to the liquidity providers? Where is the yield coming from? Is it sustainable? And where is there an end in sight? And then I think another big piece of that is how liquid is that market?
Yeah, I was gonna say, I think unfortunately for a DeFi noob today, there's just like an overwhelming amount of research that needs to happen. And I don't know if maybe like Ratio Finance in the process of doing all the risk assessments would simplify some of that research that users might need to do. But I think for any DeFi 101, like users should go in and try lending, borrowing, staking, swapping. But then part of the challenge too is like for each of those different buckets, you have tons of different protocols, and every protocol approaches yield in a different way. And then, based on our conversations now, like what is real yield, and like is there a framework for real yield that you can apply to analyze every single one of these protocols as a DeFi novice to see, okay, do I feel comfortable, investing my money in this opportunity?
Yeah, no, I really agree with what you guys just said. To be honest, right? This might not be a popular opinion, but maybe you guys do share the sentiment to a degree. I'm not sure that I would recommend just kind of aping into DeFi to a novice retail investor, right? That's not. It's not that can't work out very well, and I think most people who are at this conference have come out on the winning side of that. But I think it's just a fact that right now the space is not mature enough to be sort of easily navigated by people who don't have a specialist interest in DeFi, just because of sort of genuinely being drawn to the space. I think that maybe at some point we will get there. We'll have on-chain apps that abstract away all of these complexities that everyone here has just hit on, which would mean cross-chain bridging. It would mean some kind of standardized risk assessment for all of these different projects. It would mean some standard framework of transparency so that people would know what projects are legitimate and are actually trustless and non-custodial. Maybe that will happen, but until then, I think what's more realistic in terms of facilitating mass adoption is having a very proactive and friendly collaboration between DeFi and the right kinds of CeFi projects that already have large customer and client bases in place, have more of a Web 2 style front end that is sort of very UX oriented and that can play a curatorial role in terms of being able to provide something where they've abstracted all the complexity away for their users, and then users can just kind of choose from a menu. I would say, for projects now, and I would put Umami into this category, finding CeFi partners like that is key. And then, the other thing I would add, and it sounds like you guys are kind of moving in the direction of this, is having some kind of DeFi ecosystem standard for risk assessment and for determining which protocols are blue chip protocols with real yield that the entire space can sign on to, which I think would help with this curating process quite a bit as well.
30 seconds on this one. I'll take it from the NFT standpoint. There's a protocol called NFTX that I really like what they do. They basically have vaults where you add NFTs in, so punks, apes, doodles, whatever it is, squiggles, etc. And essentially aggregators pull from those vaults, or people can look at that vault and say, hey, I want that specific cool cat, and they swap it out and they pay a small fee to do that. And so on the NFT side, and this will blow up with GameFi for sure, something like, hey, if I have 100 swords of this game, I could lend that sword out. I mean, that's pretty amazing. So I think look in the NFT side for these real yield opportunities because they are going to pop up.
How much yield are you trying to earn on your punks?
It's pretty small in punks because the problem with the punks is they're a high dollar amount, so they don't have a lot of turnover.
Okay.
But something like My Lady or some of the other smaller projects, Wizards, they have huge turnover, and some of the APRs around 300 to 400%, and that percentage is not coming from sort of emissions. It's coming from actually people paying fees to get specific NFTs or to sweep the floor.
I saw yesterday on Twitter, or today on Twitter, that somebody had made a tremendous amount on pudgy pet penguins on NFTX. Like a tremendous amount, and it's certainly an interesting market, and I guess one that's growing. Well, I'd like to turn it over to the audience for some questions here. If anybody has anything they'd like to ask the panel.
All right, we have an audience question here. I'll ask if we can get the mic over to...
Thank you, gentlemen. That was an excellent chat. A real pleasure for all of the audience members, I'm sure. Question for Umami Finance. Was wondering if, as I understand, you guys just went through a recent new sort of V2 or restructure. Was wondering if you could talk a little bit about the history of Umami Finance, where you came from, where you are now, where you see yourself going.
Sure, that's a great question. I'm happy to chat about that. So yeah, we have kind of an interesting history, and as I think you guys will see, it's because of our kind of unique backstory that we're so sort of hyper focused on this quote unquote real yield concept now. But just for sort of full disclosure, transparency, I was not always at the helm of Umami myself. I mean, we were initially sort of the epitome of a DIY, gritty, degen, a non-led, protocol. Yeah, we were a waifu-themed ohm fork on Arbitrum, advertising 1.5 million % APY. And this was before I joined, but I got involved fairly early on. And for those of you who are familiar, I mean that ohm fork model was very attractive to a lot of people. What attracted me to it, and it's still something that I think is a good feature of Umami, is this concept of protocol owned or protocol owned, or protocol controlled liquidity on Arbitrum network, which is our native L2, which we're very bullish on its prospects. But the tokenomics were a friggin' disaster, right? And that was kind of the late, the late hours of the party, if you will, in terms of inflationary, emissions-driven APY just throughout the DeFi space, and the ohm fork model collapsed, which ultimately worked out very well. It was after that collapse that I think the original builders left. Not all of them right away, but gradually, and I took over as project lead, and some new people who shared kind of this vision of focusing on quote unquote real yield also joined. And what we do now, just to answer your question about kind of the tokenomics of Umami, which are a whole other topic of discussion, but we are very much kind of a reaction and antithesis to that early ohm fork model that proceeded when the current team was with the project. We have a hard cap at 1 million tokens. We will never mint more. 650,000 of those are already in circulating supply. So there's this very clear, fixed number of tokens, each of which constitutes a claim on protocol revenue. So 50% of protocol revenue is shared with stakers as yield denominated in ETH. Right, so it's a very clear, crisp value proposition of Umami builds these strategy vaults that I described earlier. So we identify different vault strategies built on projects like GMX and Tracer that themselves have real yield, risk hedged real yield as the engine. We take modest fees, and that constitutes our protocol revenue. And with this fixed low supply of tokens and this revenue share model where 50% of protocol revenue goes as ETH to stakers, our community has a very, very clear claim on the value that we generate, right? And I think the irony here is sort of a quick comment on the DeFi space, and then I want to hear other people's questions. That model that I just described, right? It's purposefully not innovative. It's purposefully not ultra complex and sophisticated, such that only a big brain degen could possibly understand it. And I think that has been, a shortcoming. Again, the space being kind of insular historically, there's this tendency to want to be, complex for its own sake. And I think that, moving towards simpler models, and transparency, as you guys, talked about, is going to make a big difference in terms of having more sustainable protocols.
Can I jump on that one because Tracer actually has gone through quite the restructure itself as well, and so we had a pretty big team and executed on some stuff, and so one thing you learn in DeFi real quick is you got to move fast and pivot. And one thing I'll say about Umami is when their vault launched, it really proved out the composable derivative thesis that we had. But it took 12 months and a bear market for that to happen. And your vault launched at the perfect time for us to get enough attention on what we were building in terms of these derivatives that could sit in smart contracts. And it's been great. I mean, our TVL, since that restructuring in the Umami Vault, has more than doubled. A lot of people are looking at what we're doing. They're skew farming our pools. It's led to now new product releases around perpetual swaps and some other exciting things. So it's, I want to thank you.
And your token's killing it too.
And no comment on that.
I got to say 1.5 million % APR to leading real yield summer. That's quite a narrative.
Yeah, we're 5% APR now, and we're much happier with that.
When that rebase hit, though.
One more question? Question about the yield?
It's a question for the Umami team. How do you onboard normies/noobs to DeFi when trust is so low in the space after the collapse of UST? It's from
Oh
an
gosh,
online
you're
user.
bringing up UST because of the fact that our vault yields approximately 20% APR. Is that where the association is coming from? I'm laughing a little bit because people. It's just the case that the strategy that we developed, where we provide liquidity to the GMX platform and then hedge out the risk on Tracer, happens to generate approximately 20% APR in stable ETH yield, which is then swapped for USDC for our depositors. But actually right now it's more like I think 25% APR, just because GMX has been doing really well, right? But the fact that it just worked out to be about 20% does mean that people are triggered, right, by the UST fiasco when they promised that in this sort of unsustainable Ponzi way, which again, that's a good example of some of the challenges that legitimate sort of long-term sustainable DeFi projects face, right? When other projects have tainted trust so much. I guess one key point is, like I said earlier, we're not trying to onboard noobs, right? I mean, like that unto itself is part of the problem. If your goal is to capture, someone with very minimal experience, then you have to kind of wonder what your motivation is. We're much more interested in onboarding institutional capital. We will allow them to be an intermediary with mom and pop investors, right? Which is kind of the historic function of the financial sector, is to do that, to take people's savings and to put it in, towards good use. So by focusing on, really clear, back testing and auditing and, very detailed risk assessments, like, some other folks here have talked about for themselves, and just building, trust and, lasting partnerships with a handful of, key institutional intermediaries. I mean, that's our strategy. And savvy retailer, it's a permissionless vault, right? And so savvy retailers who choose to ape in are more than welcome to do so, right? And good on them. But we're not going to actively market to that group so much.
Give a big hand to our amazing panel on yield.